Hello, everyone. My name is Andrew. Traders spend most of their time analyzing charts using technical or fundamental analysis. These are the things that really need to be given a lot of attention to achieve great success, but it is not a factor in our profitability. I have seen many new traders over the years trade only to be liquidated due to some wrong random positions. The point is that most traders leave the plan to the deal. They do not know how to calculate the volume of the future position, where to enter, where to put a stop loss, where you can partially fix the profit, and where to simultaneously transfer the stop loss to the profitable zone in order to maintain your position. The fact that you will correctly calculate the correct price movement will not mean that you will be profitable. You need to get into the position correctly and manage it. Only after that, you can really get good results on the distance. In this video, we will analyze examples of some positions. Before opening any position, you should know in advance how much money you can potentially lose if the price goes against you. This is a critical question that will determine the span of your trading career. Newbies, first of all, try to calculate how much money they can potentially earn, which will lead them to a negative scenario of events. Even with the best strategy in the world, you will not be able to trade without mistakes. Therefore, such moves will often result in serious losses or liquidation of the account. How then can you protect yourself from taking too much risk? You need to correctly calculate the size of your position. If you believe that the market will grow, then you should choose a long position on the TradingView platform. Place it on the chart, where you will enter the position and where the stop loss will be. Then you need to go to the settings of the tool itself. Specify the size of your account, but the risk on the deal. Keep in mind that the tool does not read transaction fees. I recommend using a risk of 1 to 2%. The size of your account does not matter, because sooner or later you will have a series of failures. Such a strategy will save your deposit and psychological balance. If our capital is approximately $100,000, then if the maximum allowable percentage is 1%, then we will lose $1,000 when the stop loss is activated. The position size is indicated in the middle of your deal field. If your deal goes in the right direction for you, you will receive $3,000. In the field, just below you, will see the size of the ratio of profit and risk. This is a very important parameter of every agreement. Try to stick to the minimum value of 1-3, because even with a win rate of 30%, you will still be profitable. These are the basic things that you should know before opening any trade: where you will enter, where you will place a stop loss, where you will fix profit, and how much you can lose and earn. Now, onto the topic of deal management. You have 100% been in such a situation when the price moved in the direction you wanted, did not reach your takes, and turned around. Then the trade turned out to be unprofitable, or you yourself closed your position too early. Then the price moved according to your plan, but the reward price dropped significantly. Position management is the part of trading where you are the least psychologically balanced. Because having expressed your specific point of view on the future of pricing, you will tend to see only it, even if you have equal or more substantial evidence that protests the decision you have made. In order not to look at the decisions that can be made at the moment when you are already in a position, you need to form a plan for its control in advance and stick to it until the deal is worked out according to the expected scenario or in a stop loss. Based on these schematic examples, let's look at the classic models of position management, when the deal is opened according to the trend and when it is opened against it. In the first case, the main price movement is upward. Based on the older time frames, we expect the price to come into our designated area and also remove liquidity to buy above the old high. It is expected that the zones that were formed during the correction will be broken. When reaching your first takes, you should think about under what circumstances should you close part of a position. The first take is guaranteed to preserve your position and be in a winning position even if the second take is not activated and the price goes into a loss. After the withdrawal of liquidity for sale, an entry that is in ineffective pricing could occur after a local break in the structure. Its beginning is the place where you could place your limit, and the stop loss at the last minimum is where the growth began. After the activation of the first take, the stop loss can be moved to break even for the last swing from where the upward movement continued, that is, where the position was opened. After that, I will not be interested in further pricing. I will understand that I have already implemented my idea. I took a profit from this trade and cannot take a loss. I can only earn more if the price reaches the second take. When the price direction is down, we will trade for a correction. Targets will be set on the same basis of imbalance and liquidity, but in the interval of the previous high. Here you can ignore the risk-reward ratio. There is no need to open one. One deals. Open deals on junior timeframes in the same scenario. Profit fixation in such cases will also take place in two takes. The first will be placed on the removal of the short maximum from where the local correction began, and the second at the beginning of the bearish imbalance. From there, the upward pricing will be expected to continue. After the activation of the previous take, the stop loss will actually be dragged into break-even by analogy with the first transaction. Entering a short position takes place according to the same principle. In order not to take up extra time, such schemes will not be explained.